Good morning, everyone, and thank you for choosing Market Briefing analysis of today's financial news. Every day, our goal is to provide you with a thorough and knowledgeable analysis of the most relevant financial news to help you navigate the complex economic landscape. Let's begin our daily review. Financial news, June 27, 2023. Equity markets started the day with hopes of recovering from recent weakness. However, the Stoxx Europe 600 index faced some setbacks as European Central Bank President Christine Lagarde tempered expectations of an immediate end to the interest rate hiking cycle. Nonetheless, Prosus NV experienced a significant jump of nearly 10% following regulatory approval to remove its cross-holding structure, with Naspers Limited on the other hand. Volkswagen AG dragged down auto stocks due to weak sales. Meanwhile, S&P 500 and Nasdaq 100 futures demonstrated a modest rise of approximately 0.3%, aiming to rebound from last week's losses, which were the worst since March. Concerns lingered over the possibility of the Federal Reserve pushing the U.S. economy into a recession. However, market participants are gradually accepting the notion that interest rates may not be cut this year. Many believe that any potential recession could be less severe than initially feared, offering some reassurance to companies' earnings. As central banks approach the end of their rate hiking cycles, investors are finding hope in the prospect of a relatively soft landing for the economy. Mark Dowding, Chief Investment Officer at Blue Bay Asset Management, highlights the resilience of global growth thus far and suggests that a less severe recession may be on the horizon. However, Lagarde's recent comments in Sintra, Portugal, raise concerns that central banks may continue to push rates higher, potentially reversing fragile economies. Later this week, central bank representatives from the US, Japan, and the UK are scheduled to speak at the same forum, providing further insights into their monetary policies. Amid global economic concerns, signs of resilience are emerging from China. The country took steps to counter investor pessimism by increasing support for its currency, the yuan. State-owned newspaper China Securities Journal noted that pro-growth measures would improve the yuan's outlook. In positive news for U.S.-China relations, U.S. Treasury Secretary Janet Yellen is reportedly planning to visit Beijing next month for talks with her Chinese counterpart, He Lifeng. This development suggests a potential improvement in the bilateral relationship, which could have positive implications for market stability. Asian equities experienced a much-needed boost, with a gauge of Asian equities poised for its first advance in 7 days. Hong Kong-listed technology stocks drove this rally. Meanwhile, the yen remained around 143.50 against the US dollar, depreciating almost 10% this year. Tokyo responded by extending the term of its top currency official, Masato Kanda, for another year. In the commodities market, oil prices continued to rise, supported by optimism surrounding Chinese stimulus efforts. Additionally, uncertainty surrounding Russian crude output following a recent incident involving Yevgeny Prigozhin, leader of the Wagner mercenary group, contributed to the price gains. Stocks are grappling with concerns over growth and interest rates, while central bank policies and global economic trends continue to influence market sentiment. The ongoing developments in China and the positive signs in U.S.-China relations offer some hope for stability. As always, stay informed and tuned into the ever-changing world of finance. Before we continue with our analysis, we'd like to remind you of your support for our channel Market Briefing analysis of today's financial news. If you're enjoying this video and find our content useful and engaging, please consider giving it a thumbs up and subscribing to our channel. This helps us grow and bring you even more quality content. Now, let's get back to the financial market news and the latest updates. Here to bring you the latest news in the world of finance and markets. Today, we focus on the significant events that unfolded in the tech sector, leading to a sell-off in major U.S. indexes. We also explore the potential risks of a major correction and the impact of macro factors on risk assets. So, let's dive into the details. The tech sector faced a significant downturn, as investor enthusiasm over artificial intelligence waned, giving way to a more cautious assessment of current economic conditions. Alphabet experienced a 3.27% decline following a downgrade by UBS, which cited fierce competition in the AI sector. Nvidia and Meta Platforms also suffered losses, with each falling over 3%. Tesla, in particular, faced a plunge of 6.06% after Goldman Sachs downgraded the electric car maker, citing a challenging pricing environment for new vehicles. Consequently, the Nasdaq Composite Index experienced a decline of 1.16%, while the S&P 500 fell by 0.45%. The Dow Jones Industrial Average dipped slightly by 0.04%. The sell-off in the tech sector has raised concerns about the sustainability of the tech rally, as it is highly dependent on lower interest rates. Berenberg, a German bank, suggests that tech, as a forward-looking industry, requires lower rates to continue its upward trajectory. However, with the Federal Reserve signaling its intent to keep rates high for the time being, the prospects of lower rates imply a potential sharp economic slowdown. Jonathan Stubbs, an equity strategist at Berenberg, points out that such a scenario would be detrimental to the tech sector. However, it is important to note that an economic slowdown would not be beneficial for any industry. Miles Wilson, Morgan Stanley's chief U.S. equity strategist, warns of the increasing risks of a major correction in the stock market. Wilson, who accurately predicted the market's decline last year, suggests that the S&P 500 could drop to 3,900 in the fourth quarter, representing a decline of approximately 10% from its Monday close. This outlook places Wilson among the most bearish voices on Wall Street. Despite the sell-off in the tech sector, the three major indexes are poised to finish the second quarter higher, providing some respite from concerns of an impending recession. Ajay Rajayaksha, Barclays Global Chairman of Research, emphasizes that macro factors will likely remain the main drivers of risk assets, overshadowing the recent events in Russia. The tech sector experienced a notable sell-off as investor sentiment shifted and concerns over economic conditions grew. The potential risks of a major correction loom, and macro factors continue to shape market sentiment. As always, stay informed and closely monitor the developments in the world of finance. Some of the main moves in markets. Stocks. The Stoxx Europe 600 was little changed as of 9:40 a.m. London time. S&P 500 futures rose 0.2%. Nasdaq 100 futures rose 0.3%. Futures on the Dow Jones Industrial Average were little changed. The MSCI Asia Pacific Index rose 0.3%. The MSCI Emerging Markets Index rose 0.5%. Currencies. The Bloomberg Dollar Spot Index fell 0.1%. The Euro rose 0.3% to $1.0937. The Japanese yen fell 0.2% to 143.76 per dollar. The offshore yuan rose 0.3% to 7.2186 per dollar. The British pound rose 0.1% to $1.2731. Cryptocurrencies. Bitcoin rose 0.7% to $30,379.86. Ether rose 1.4% to $1,876.70. Bonds. The yield on 10-year Treasuries advanced 2 basis points to 3.74%. Germany's 10-year yield advanced 1 basis point to 2.32%. Britain's 10-year yield advanced 3 basis points to 4.33%. Commodities. Brent crude rose 0.6% to $74.63 a barrel. Spot gold was little changed. In conclusion, we'd like to thank you for watching Market Briefing analysis of today's financial news. If you enjoyed our insights and found the information helpful, please consider leaving a like and subscribing to our channel to stay updated with future analyses. Thank you again for your support, and we'll see you soon with more fascinating news. Remember, the information in this video is purely informational and does not constitute investment advice. Always consult with a professional before making financial decisions.